Hi everybody, it's a deep dive into Amazon. We'll be discussing first Amazon's financial performance to see what key trends we can see in the numbers, what it tells us about the business, and how we can use this information for forecasting. Then we compare Amazon against key peers like Nvidia, Apple, Microsoft, Meta, and Alphabet, aka Google. In other words, we compare the Magnificent Six against each other. Since we're doing a comparison based on historical metrics, I'm not including Tesla because Tesla is a more forward-looking case. Then we move on to forecasting. I will walk you through key assumptions and, of course, outcomes. And then we'll also take a look at consensus to see whether what is presented to you is above or below consensus. That's a key thing. And then lastly, we talk about valuation. We talk about what metric one should use in Amazon's case and why. And then everything culminates in the potential upside or downside at the current share price. And before we close, we look at kind of the opportunity to see whether Amazon might be an attractive case for long or short investors. Before we dive into the main part, let's just get some basics out of the way. So this is the year-to-date share price chart. The stock closed at $231, and the stock is up 5.3% year to date. Over here we have some basic metrics about the stock. So the beta, the volatility of the stock is 1.3. That is more on the low side for tech stocks. And down here you see in the last 52 weeks, the stock traded between $161 and $242. And you can see down here also the average volume, which is 42 million shares per day. That translates in just under 10 billion in trading volume per day. And that makes Amazon a highly, highly liquid stock. Just as a point of reference, Tesla's average daily trading value, dollar value traded, is around 25 billion. And this already gives you some indication as to the difference between these two companies. Even though the market cap of Amazon is roughly 2.5 times Tesla's, Tesla has 2.5 times the trading value. The dollar amount traded is a strong indicator of the interest around the stock, and it is also important for valuation levels, but this is something we discuss later. So this next chart shows you the performance of the S&P 500. This is also year to date, and you can see the S&P 500 is up almost 10% this year. This means Amazon significantly underperformed the market this year, and that's always you should be looking at as just a key due diligence item when you start looking at a stock. A stock not having kept up with the market doesn't necessarily mean that gap later closes, i.e. stock is primed to catch up with the market. We'll be discussing later the reasons why that is. So Amazon recently popped up more frequently in my feed. For example, this is a very recent, this is an excerpt of a very recent article. Bill Ackman, famous investor, just recently increased meaningfully his Amazon holding. And next, we look at what analysts think. So their price target over the next 12 months is $262. So that's only about 14% from current. But of course, that's the average. It doesn't mean it has to be correct. In fact, quite often these price targets are quite off. And that's why I personally mostly look at these price targets in terms of what is the kind of, let's call it Wall Street sentiment view of the stock. Then in terms of recommendations, so what you see here is the number of analysts that put strong buy, hold, underperformance, sell on the stock. So there's no analyst that says puts a sell on the stock, or we just can't see it because there are so many analysts. But by the way, the 69 number is the total number of analysts that most recently, as of this month, August, provided a recommendation. 69 is a huge number. This makes Amazon one of the most or best covered stocks on the planet, or in the stock markets. But you can also see that only around 20% of analysts put a strong buy on the stock. Most of them, the vast majority of them, puts a buy on Amazon. There appears to be only a very small number that puts a hold on the stock, and at least graphically, we cannot see anyone putting an underperform or sell on the stock. So overall, the analyst community is appears to be quite in sync. So on this first chart, you see Amazon's revenue trend, quarter by quarter. This is for the last 4 years from the last reported quarter's perspective. The last reported quarter is the second quarter of 2025. So from the most recent quarter's perspective, the most recent year, full financial year, spans over Q3 2024, Q4 2024, Q1 2025, and Q2 2025. This last 4-quarter period is also called LTM, or last 12 months. Amazon's fiscal year overlaps with the calendarical year, so it goes from January to December, but charting years in this way, creating a last financial year from the latest quarter perspective, provides you a better, or I should say more up-to-date view of the most recent annual growth rate. And for this reason, I'm using this approach throughout this presentation. So the key observations on these charts are the following. Number one, the second quarter grew 13% year over year to 168 billion. And the last 4 quarters are up 10.9% to 670 billion on a year-on-year basis. And this annual growth rate of 10.9% is a little bit below the prior 12-month year-on-year growth rate of 12.3%, and is a tiny bit ahead of the prior year to that year growth rate of 10.7%. So over the last 4 years, the most recent 1 year period was the second fastest growing. And then you can also see in this quarterly chart, and that's why always looking quarter by quarter is so important. There's quite significant seasonality in Amazon's business. You can see that the fourth quarter is by far every year the strongest quarter. And that's simply because Amazon has significant seasonality caused primarily by the Christmas business. People just buy a lot of presents on Amazon, or third-party sellers that sell through Amazon in some way. And that always creates a massive revenue spike in the fourth quarter. Then also what we see in the trend is that, and this is very consistent, that after the fourth quarter, then obviously we have a significant sequential drop-off that ranges between 15 and 17%. And you can see this here, here, and here, and here. And then we see a quite consistent sequential improvement after the first quarter. So the second quarter is always stronger than the first quarter, but always slightly weaker than the third quarter. And then you have the third quarter always coming in as the second strongest quarter in the year. So when you do forecasting, it's always very important that you keep, or that you reflect a business's seasonality. If a business has major technological changeovers, for example, like NVIDIA, you also have to factor these technological changeovers into your forecasting. But in Amazon's case, it's just a simple 4-quarter annual cycle. So at 670 billion of revenue over the last 4 quarters, this makes Amazon the by far biggest revenue generator amongst all of the Magnificent Seven. In fact, Amazon is about 40% larger in terms of revenue as the second largest revenue generator, which is Apple. Now we're looking at the most recent income statement as published by Amazon. Amazon calls it consolidated statements of operations. So a statement of operations is exactly the same thing as a P&L. P&L is profit and loss statement. Income statement is the same as P&L, and consolidated statements of operations is the same as P&L. It's all synonyms. So the reason why I'm showing you this is to show you how Amazon chooses to break out its revenue. So Amazon splits it into net product sales and then net service sales. This is something very important to keep in mind. Amazon also provides a geographic split into North America, international, and then also AWS. We won't be using that kind of split for forecasting, and I will discuss later why. We will be using actually this split, which I believe is by far the most useful that Amazon provides, because they also split revenue into online stores, physical stores, third-party seller services, advertising services, subscription services, and AWS and other. You can see other is a tiny component, never more than 1% of revenue, hence we will not be discussing it. It's not a needle mover. So we will be focusing on these remaining 6 categories. And just for orientation, the prior split into product and service matches almost exactly in the following way to this split. So the products revenue stream comprises of the online store and the physical stores. And the services revenue comprises of the remaining 4 segments, so the third-party seller services, advertising services, subscription services, and AWS. The reason why I'm showing you this level of detail is there's a significant transformation going on in Amazon's business. And to understand fully the financial ramifications of that transformation, we need to understand the key business segments Amazon operates in. We are obviously all familiar with the website, the online store, Amazon.com, but Amazon expanded in a lot of other areas. And what we need to understand is the relative growth of these different areas, and then of course profitability in this area. So before we dive into the individual segments, the 6 buckets we just looked at, let's just look at the high-level product and services split that Amazon provided. So first on this chart you see the product sales, and you can see it's up in the second quarter 11% year over year, and that was actually the strongest year-over-year growth rate in a long time. As you can see in the second row of percentages, the first row is the quarter over quarter, second is year over year. So that's very positive. And then you have the LTM. The LTM is up 7.5% year over year. And the way I typically look at the latest quarter year over year and the latest last 12 months year over year, the LTM gives me kind of a bigger picture, a more long-term view obviously. But the latest quarter year over year sales trend gives me a more recent look at how the business is performing. And when we look at these numbers, we can clearly see that this is, in at least the 4 observed years in this analysis, the by far strongest growth rate. And we can also see that 4 years ago, Amazon's products business went through a rough patch where it actually decreased by a tiny bit year over year. But it of course there was the second half of 2021 and then the first half of 2022, and that was obviously a difficult year due to COVID. Then also overall, what is product sales? Product sales is everything that comprises revenue from items that is sold from Amazon's inventory. Because there are a lot of products that are being sold seemingly via Amazon, but they are not. And in such cases, Amazon only provides a service and would account for that as a service revenue. Give an example. In most places, LG, a large electronics company, has a store on Amazon's website. But when you buy something on Amazon.com from that hosted web store, let's call it on Amazon.com, Amazon only provides a service, does nothing in terms of fulfillment of the product. It takes care of the payment, yes, but the product goes directly from an LG product storage facility to your doorstep. It does not go through Amazon warehouse. Then we look at the other large bucket, service sales. So Amazon books anything or shows everything under service sales that represent third-party seller fees or commissions and any related fulfillment and shipping fees. Also includes any AWS sales. So AWS stands for Amazon Web Services, which is essentially Amazon's very large cloud business. But then also service fees comprise advertising services, and then of course Amazon Prime membership. But then also it includes Amazon's version of Netflix, where it does sell its own content to consumers. But now let's discuss the service revenue or service sales numbers. The second quarter was up 15% year over year, and that is in line with the prior year's second quarter, but is below the second quarter of the years prior to that. Then also when we look at the LTM, last 12 months, service revenue grew 13.5% year over year, and that is the slowest growth rate in the last 4 years. So the first key observation here is that product sales grow faster. Let me repeat that or start over. The key observation is that service sales grow faster than product sales, but the growth trend, the change in the growth rate, is more positive in the product revenue. So one is about growth, service is stronger, but what is the trend in the growth rate? And here products is stronger. So on this next slide, we compare directly the absolute revenue, so the dollar amount generated in the products category and in the service category. And the first key observation is that the service category has become Amazon's main revenue type. It's not products anymore. It used to be products, but about 4 years ago that flipped because services kept outgrowing products. The 168 billion total revenue that was reported in the second quarter, 99 billion of that came from services, and only 68 billion came from products. The other point I would highlight in this slide is that both products and services have significant seasonality, as you can see in these spikes. Again, this is driven by the Christmas or fourth quarter business. Here on this next slide, we look at it in terms of relative contribution, so in percent. In the second quarter of 2025, the services business has grown to almost 60%, 59.3%, which is a new all-time high contribution. And logically, as a result, the products business has dropped to an all-time low of 40.7%. So the key takeaway from this slide is that there's a very strong trend towards services. That's very positive for Amazon because the services segment comes with much higher margins. And this has been a trend that has been intact for many years now. And this appears to make it more likely to continue into the future and effectively transforms the business. So I think this is a first key insight into the business. But let's move on. This slide then brings everything together in terms of how to think about Amazon's revenue. As we discussed earlier, so there are two big main buckets that Amazon discloses, which is products and services. And then the key segments disclosed within each of these main buckets. So the online store and the physical stores comprise almost entirely the products revenue stream. And then services comes entirely from third-party seller services, advertising, subscriptions, and AWS. There's a tiny bit of product revenue that sits in these four buckets and is then being consolidated into the product stream. But it's just a small detail. It's not a needle mover, just something to point out. Because if you add up in Amazon's disclosure the revenue for these buckets, online store, physical store, you will not get exactly the products number. And the reason is because of what I just said, that some products revenue, but it's a very small amount, sits in these buckets, in these services buckets. I will not read through the description of each of these buckets. They provide you with some more detail around what each of these segments do. So if you're interested, please stop the video here and just look at the slide. But I think most listeners will likely be familiar with a lot of these services. So the online store is Amazon.com. There are some physical stores in certain selected locations. It also includes the Whole Foods business or Amazon Fresh supermarkets, or also certain new models Amazon is experimenting with. For example, stores where there are no cashiers. The third-party seller services business, I already mentioned the example of LG. So this business enables third-party vendors to leverage the logistics of Amazon to a certain degree. Amazon has also a quite sizable advertising business that is often not discussed. I think the subscription business is understood by a lot of consumers because it touches a lot of people's lives on a daily basis. I think a lot of people have Amazon Prime membership or watch a Prime Video, or they might have a Kindle on which they read, or have the Audible app. And then, of course, there's the very important Amazon Web Service or AWS business, which is the very large cloud computing division of Amazon, and where Amazon provides on-demand infrastructure to large customers typically, where Amazon manages the storage, retrieval of data, also started providing AI-powered tools and compute to large organizations, governments. It's also attractive to smaller businesses because the model is, with few exceptions, mostly a pay-as-you-go. So the more you use it, the more you pay. And the less you use it, the less you pay. And that's why it's attractive to all kinds of business sizes, because an alternative model would be some sort of large base fee, which can be a significant hurdle to small businesses. So next, let's compare these 6 main revenue drivers or businesses. And this is what this chart does. Just real quick in terms of coding. So the dashed lines comprise product segments. So the online stores and the physical stores, here in green and down here in red. So the key observation here is that in terms of revenue, the online stores is still by far the biggest revenue driver of the business. It has quite substantial seasonality, which you can see by these huge peaks and troughs. On the other hand, the physical stores, they have hardly any visible seasonality at all in the numbers. But it's also because their revenue is so small that on this scale, their trend line is being compressed quite a bit. But the key observation is that physical stores play not a meaningful role in the Amazon business overall. So the numbers show in the largest segment, Amazon generated 61 billion on the website in the second quarter and only 6 billion, so roughly call it 10% or 1/10 in physical stores. Then the second largest revenue driver is the third-party seller services business, generating 40 billion, also with substantial seasonality. Again, the online store and the third-party seller services are closely related because it's all mostly through the Amazon.com website. It's all a consumer business, and therefore we see the similar pattern in terms of seasonality. Just in terms of economics, it's very different. So the online store is very capital intensive because Amazon has to build all this infrastructure, while in the third-party seller services, it only extends services to third parties. Then the third largest segment in terms of revenue is AWS. And you can see this business has basically no seasonality at all relative to these already discussed segments. So that's something we have to keep in mind. And there's also a reason why when you model Amazon, you have to model it by these segments so you can capture the quite substantially different growth profile of each of these businesses. Then we get to the fourth most important business in terms of revenue, that is advertising services, provided 16 billion in the second quarter. And then subscription services provided 12 billion. And here too, subscription services, unlike the other segments except AWS, has also no visible seasonality in the revenue trend. So this next chart looks at revenue by contribution. So again, we moved on from dollar to percent now. We just go through this very quickly. So the largest segment, online stores, a product type revenue stream, contributed 37%. The key takeaway here is that there's a long-term downward trend in terms of contribution. So the online store where Amazon sells products out of its inventory is becoming increasingly less important in terms of revenue. The third-party seller service business, the second most important, contributed 24.3% of revenue in the second quarter. The importance of that business has been growing, but only moderately. So in the last 3 years, when we look at the second quarter, we moved from 22.8% contribution to 24.3%. So it's an increase, but not a dramatic change. We can observe a similar trend in AWS. It has also been increasing, but also not dramatically. But here we have to keep in mind it's a matter of relative sizes. The online stores business, or the Amazon.com business, and also the aggregate amount of all the other business creates such a large revenue base that it's difficult for any business to become like a dominant revenue stream. So that's why, even though the trend looks kind of weak in terms of increasing importance in third-party seller services in AWS, the underlying makes actually a meaningful difference, and we'll see this later how this plays out in the numbers. And then blue line advertising services also is expanding, reaching all-time high contribution of 9.4% in the second quarter. Subscription services quite constant, 7.3%, have not really moved on in the last 4 years in terms of revenue contribution. And we can make a similar comment about physical stores with 3.4% of revenue contribution, which very low, a very small contributor, a very small needle mover. So now let's run quickly through the 6 segments revenue trend. So here the first main segment and the largest segment by revenue contribution, online stores, up 11% year over year in the second quarter. In the last 12 months, this segment is up 7.6%. Both of these growth rates are the strongest in several years, so it's very positive. Next, we look at physical stores, so the second product type revenue stream. Here, growth is much lower. Second quarter was up only 7% year over year, and the last 12 months was up 6.9% year over year. It's also with 3.4% revenue contribution to total revenue. The smallest segment, so everything not very exciting. So physical stores is not a driver for Amazon, at least not at this point. Now we look at the second largest segment in terms of revenue contribution. That's the third-party seller services business. This business grew 11% in the second quarter, and over the last 12 months grew 9%. So that's pretty good. But when you look at the prior years, you can see, first of all, in the quarterly trend, about a year ago, year-on-year quarterly growth rates were much higher, 12, 16, 20%, 20, 18, 18, 20, 18%. And then also on an annual basis, the LTM, so the last 12 months, 1 year ago, grew almost 17%, not 9%. And the one prior to that one grew almost or over 18%. And the one prior to that one, so 4 years ago grew 11%. So this part of the business appears to be experiencing some slowdown, but we have to see. Next, we look at the advertising business. That is up 23% in the second quarter, so it's a really strong growth rate. And then the last 12 months is up 19.3%. But here we have a slightly similar picture, even though these growth rates are still quite impressive and very strong. They have come down a little bit compared to when you go back more than a year, we saw on a quarterly basis year-on-year growth rates of 20%, 24, 27, 26, 22, 21, 19. Okay, it's lower. And this resulted in much higher, or meaningfully higher, I should say, full-year growth rates. Here again, big question mark, can this revenue expansion continue at this high level, or do we see potentially signs of slowing? Then we look at subscription services. That business was up 12% year over year in the second quarter and is up 10.6% over the last 12 months. We see also a slightly similar picture that a little over a year ago, we saw a period of significantly higher growth, and that piece also slowed a bit. Still very good growth rates. I mean, double digits is nothing to frown upon, but something I think investors should look very carefully at. And then lastly, we look at perhaps the most important business for Amazon, which is AWS, so Amazon Web Services. And the reason why I call it maybe the most important business, it's not because the revenue contribution, it only ranks number 3, but it's high margin software type revenue stream. It's not quite software type margin, but it is by Amazon standards a quite high margin business. This business continues to see strong growth rates, so it grew 17% year over year in the second quarter and is up 18% over the last 12 months. And that is actually a let's call it a re-acceleration compared to the prior 12 months when the business grew 15%. So that's very positive. And now let's look at the company's guidance. So Amazon, every quarter when they release quarterly numbers, they also provide guidance for the next quarter. So, and I think every good analyst should always study how that guidance compares to actually later delivered results. And this is what this chart does. So the green line shows the high end of the provided guidance range, and the red line shows the low end of the provided guidance range. And the black line shows you what was actually later reported. So as of right now, August 2025, we know the guidance for the third quarter, but of course we don't know yet what Amazon will be reporting. And that's why we can't draw the black line all the way to the third quarter. The first key observation is that the guidance range is reasonably narrow. So for example, for the third quarter of 2025, Amazon predicts 174 to 180 billion. That's only a 3.4% range above the low, so that's not bad at all. But then obviously the key observation when you look at this chart is that the black line, so what was actually reported, comes in most cases, in about 2/3 of cases, consistently above the high end. And I'd like to point out, this chart looks at the last 16 quarters. And when you see so frequently outperformance over the high end of the range, this only means one thing and one thing only. Management is clearly sandbagging, since there's obviously a huge underestimation bias in their estimation. You cannot outperform one quarter after the other in most cases and pretend you have no estimation bias. Or in other words, if you eyed the low end of the guidance range, in the vast majority of cases you were off quite a bit. So practically speaking, for anyone who wants to forecast Amazon, what you should be doing, you should be looking at the high end of the guidance range and adjust for the observable estimation bias. And that estimation bias is approximately 0.2 to 0.9%. Because if you're an analyst, no matter how good you think you are and how many little spreadsheet models you build, you have such an enormous information disadvantage compared to management, you will never be more accurate than them. If you are, it's just a pure fluke and it's a non-repeatable achievement. So that's why we would highly recommend just go by what management gives you, check for the track record and adjust for whatever estimation bias might be observable. And I can tell you, no amount of research on web traffic, etc., or how many trucks leave Amazon warehouses like in the early days will help you to improve your accuracy. So here on this next slide, this is basically the same analysis, but in a slightly different way shown. Here we look at the midpoint of the provided guidance range and compare it to what was actually delivered. And you can see this blue line with one exception, in all these 16 observed quarters, was always meaningfully by at least 1% above that midpoint. That means even taking the average of the provided range is not a good basis for your estimation. You should always look towards the high end of the provided range. So for what you see on this slide basically shows you that at least over the last 8 quarters, Amazon's average or median outperformance over the midpoint was 1.8% or 2.2%. So, but this is revenue. So Amazon also provides operating income guidance. So now let's look what the picture is in that metric. And this is what you see on this slide. Here the outperformance is even stronger, or let's call it what it is, the sandbagging. Amazon in most cases significantly outperforms the high end of the guidance range, and the strategy behind all of that is quite obvious. Amazon first of all provides a conservative forecast, so it under-promises, so it's easier to over-deliver. This then creates the highly predictable positive headline, Amazon beats guidance, or some variation of that headline that the talking heads on TV, etc. will spread, and people that write articles about Amazon will include, or Amazon beat guidance. Even though this quote-unquote beat is only the result of permanent sandbagging. It's actually kind of a lazy management. It's clever, but it's lazy management because they always outperform their range. It means they put out a lazy range that they can quote-unquote easily achieve. Because if it was an ambitious range, there would be much more frequently misses, or there would be at least more in the mid or lower part of the range more often. This is not the case, so management actually plays it easy. But it's clever, it works, it produces predictably positive headlines, and a non-zero number of investors will fall for that. So on this next chart, which looks a little bit weird, we look at the guidance midpoint for operating income and compare it to actually delivered, and look at it in terms of percent outperformance, and you can see it's massive. So I cut the scale at 50% because the outperformance in some cases was so enormous that it makes this chart hard to read, and is actually not that important. It has to do with some accounting stuff in Amazon's numbers we talk about later. And that's why I'd like you to focus only at the last 5 quarters. So the outperformance average median was around 22%. And in the most recent quarter, the operating income came in 25% above the midpoint of the guidance range. This just shows you the enormity of the sandbagging that's ongoing. Next, let's talk about gross profit. But before we dive in, let's talk about how it's being calculated. So this is Amazon's income statement again. You can see here the total revenue line called total net sales. And then you have the first line item of cost of sales. Amazon chooses to put it in operating expenses, but I have to agree with Amazon. Gross profit is really a tricky concept, or a tricky metric to apply to their business, because a lot of items that would be reported in cost of sales in other types of businesses, Amazon puts into fulfillment, but then also fulfillment includes elements that would always be included in operating expenses, so this makes it very tricky. That's why I take the following gross profit number with a sort of grain of salt. So now back to the gross profit trend. So gross profit was up 17% year over year in the second quarter, and is up 14.5% over the last 12 months. That shows a similar trend to the one we discussed previously, that when you go back a year, 1.5 years, we saw a period of significantly stronger gross profit growth. And also when you look at the LTM, the prior years showed stronger year-on-year growth. So this earnings metric is showing some weakening in a way. However, the second quarter was quite encouraging. Then we look at this metric in terms of gross margin, so gross profit divided by total revenue. And here what's quite interesting is that we have achieved yet another all-time high at 51.8%. This is actually the reason why I show you this metric, because it gives you another angle into how the business is actually transforming from a mostly products and let's call it hardware business to a more capital-light, software-oriented business. So the shift in revenue that we already determined from products to services is also showing an effect in margins. Next, we move on to operating profit, but here again, let's take a quick look at Amazon's SEC filing. You can see operating income here. Operating income, operating profit is the exact same thing. You can see here the second quarter of this year, 2025, 19.2 billion. But as always, to see a trend, SEC filings are not that useful. You need to convert them always into a time series. So let's go back to this presentation, and you can see operating profit was up 31% year over year in the second quarter, and in the last 12 months was up 40.1%. So very, very strong growth, but does not compare obviously with the 12 months growth rate seen in the prior 12 months period, where operating profit was up 207%. But that obviously came on a rather low base. And then we look at the same metric in terms of operating margin. And you can see that the second quarter of this year at 11.4% was the strongest quarter in strongest second quarter in several years. And the implied operating margin over the last 12 months rose to 11.4%, which is the highest ever reported. This also demonstrates the transformation that's ongoing in the business from this mostly products business at super low margins to a more services business that generates significantly higher margins. Next, we need to talk about operating expenses. So when you look at operating profit, you always need to look at operating expenses to understand what is driving a deviating trend between gross profit and operating profit. But let's look at what operating expenses includes in this analysis. As I showed you earlier, I included in gross profit cost of sales. So this is not included in the following operating expense review, because in my analysis I consider fulfillment, technology and infrastructure, which is mostly R&D spend, sales and marketing, general and administrative expenses, and other operating expenses as operating expenses. And that is why my total operating expense number deviates from the total operating expense number you see here. So Amazon reported 148.5 billion, but this includes 80.8 billion in cost of sales, which, as I just explained, I reflect in gross profit. And from the gross profit, I then deduct these, 5 items to get to my operating income. That's why my operating income is then again consistent with Amazon's disclosed number. And I'm doing this restructuring, this small restructuring of Amazon's income statement for analytical purposes to mostly calculate more meaningful margins. So with that out of the way, let's look at the operating expense trend. So operating expenses were up 14% in the second quarter and are up 8.6% over the last 12 months. This is a re-acceleration in operating expense growth. Next, let's look at what is driving this increase in operating expenses. It's not fulfillment cost. Fulfillment cost is growing slower at 10% in the second quarter. Here we see a major driver, which is technology and infrastructure. Technology infrastructure mostly comprises of expenses for payroll and related costs for employees in R&D, so research and development. So what you see is basically the effects of the AI talent war, which is also not only reflected by significant payments for key talent, but also an overall expansion of the R&D activity as companies try to figure out how they can transform their current software infrastructure into a more AI-based infrastructure system. At 27 billion R&D spend, Amazon is one of the largest R&D spenders globally. And with the spend of 96 billion, this company invests an enormous amount just in research and development. Not a major driver was sales and marketing, which was up only 9% year over year. General and administrative expenses actually decreased and have been decreasing for 3 quarters in a row, down 2% in the second quarter, and over the last 12 months decreased by 1.6%. I think what you see in these numbers is already efficiency gains that come through the use of artificial intelligence. Now we're looking at overall operating expenses in terms of operating expense margin, so operating expense expressed as a percent of revenue. And we can see that in the second quarter, Amazon spent 40.4% of revenue on operating expenses. That is quite high. And you can also see in this trend that Amazon tried to bring this down. But on a year-on-year basis, spend still slightly increased by, you can see up here, this is shown in basis points, slightly increased by 16 basis points. So whatever AI-related efficiency gains Amazon generated, all of that was eaten up by increases in R&D spend. And this is a trend I've been observing in many other companies I'm covering. They tend to be performing quite well on especially G&A, so general and administrative expenses, but then the R&D spend is going through the roof. So, and I think this will be an ongoing trend for some time because companies are just trying to compete, and the competition in the AI space is quite fierce, and there are very large companies that throw around huge paychecks, which makes this talent war very, very expensive. Let's look at fulfillment. So fulfillment improved year over year. 15.5% of revenue was spent on fulfillment. That is an all-time low for a second quarter. So as I said before, this is not a cost driver. Then we look at R&D. So 16.2% of the total revenue spent on R&D in the second quarter. That's up 113 basis points, or 1.13% of revenue more was spent on R&D. However, I should point out this is not the all-time high for a second quarter. This was in the second quarter of 2023. But I expect that pretty soon we will see new all-time highs on R&D spend. Sales and marketing spend continues to decrease as a percent of revenue, is down 30 basis points year over year to 6.81% in the second quarter. Then lastly, we already talked about general administrative expenses is down to is 29% basis points down year over year to just 1.77%. That is very low. Even relatively efficient companies tend to have 2% or over 2%, or slightly over 2%. So 1.77% is really low for any company, really. Next, we have to talk about operating expenses, which is, in Amazon's case, a surprisingly important topic. In most companies, non-operating expenses are not really needle movers, but in Amazon's, it is quite important because Amazon does not provide adjusted earnings or non-GAAP earnings, and they just produce the GAAP earnings number. And that is a big problem because Amazon has certain investments that create enormous volatility in the non-operating items line, which comprises interest income. This is no problem. Interest income is fairly steady. Also, interest expense is completely uneventful. But then there is other income in the non-operating items, and that item includes gains on investees or losses. These gains and losses are non-cash. It's just the security of a investment. In Amazon's case, the investment in Rivian created enormous volatility. And this is what you see in this trend. So in the fourth quarter of 2021, you saw non-operating items worth 11.5 billion. And this and almost the entire amount was driven by Rivian, because Rivian IPO'd in that quarter, and that led to a huge unrealized capital gain on Amazon's part. So there was no cash inflow into Amazon, but for accrual accounting purposes, Amazon recognized the gain, and that gain reached all the way down in the income statement to the earnings per share number on a GAAP basis. And that's a big problem because it created a huge spike in earnings per share, which is, however, completely meaningless. And every analyst on Wall Street would adjust for that. But the problem is then every analyst is forced to produce its own adjusted earnings number. This is not great. So for that reason, a lot of companies, they give every quarter an adjusted earnings number and an adjusted EPS that reflects management's best view of what items should not be considered like as an ongoing indication of earnings power. And huge gains in equity investments certainly would not be part of that. Because when you look at Amazon, after this huge gain, and again, there was no cash inflow for Amazon, there was just accounting gain, there was a huge accounting loss. Also, no cash outflow was also caused by Rivian, because then after the Rivian bubble burst, share price collapsed very quickly, and Amazon had to take down its written up asset to now much lower value, and the change in value is then the loss that you recognize in the P&L, created a loss, a quarter where Amazon reported loss. The same thing happened the quarter thereafter. Rivian share price collapsed even more. Amazon was forced to take another write-down of the investment. And then after things normalized, so did the volatility in the non-operating items line. And this is why you see these changes came down, but they still cause quite significant volatility in Amazon's earnings. And the fact that they do not provide an adjusted number is therefore making kind of tricky for Wall Street to land on the EPS. In my view, it's not hard to adjust the earnings number. And as far as I know, a lot of analysts have chosen the same approach because it's quite obvious. But still, it would be good if the company would provide an adjusted earnings number. But they don't. And the main reason why this is a problem is because this volatility causes the EPS to jump up and down so much, we cannot use that EPS that we get from Amazon to derive multiples. Because the resulting multiples of this EPS volatility, the result of that is that the multiple jumps all over the place. And the best multiple is one, no matter what metric you use, that is fairly stable. So that's why we need to adjust it. But this is something we'll be discussing in the valuation section. Here on this next slide, we just look at the Rivian investment gains and losses Amazon recognized. You can see here in the fourth quarter of 2021 that the whole issue kicked off. Amazon recognized a gain of 11.8 billion, huge. Then the subsequent quarter, they took the write-off of 7.6 billion. Then the quarter thereafter, second quarter of 2022, they took another write-off, 3.9 billion. Then in the following quarter, after that quarter, they took another write-off of 1.1 billion. So this was a really frustrating period for Amazon during this period, because Rivian totally for 5 quarters straight completely messed up Amazon's earnings. So they had this huge one-time spike, and then 1, 2, 3, 4, 5 quarters, Amazon was forced to recognize significant write-offs. And this volatility issue caused by Rivian is something that's still plaguing the company to this day. So for example, in the first quarter of 2024, there was another 2 billion write-down. Then there was a write-up afterwards, 200 million. And then in the second quarter of this year, and there was a write-up of 400 million. If you're a CFO, and I advise CFOs, what you don't want is significant volatility in your P&L, because that always triggers questions from analysts that are always a little tricky to answer, because how are you supposed to answer a question or do you expect further volatility from your investment and so and so? That's like asking, please predict the share price of security so and so. There are a huge number of unknowns that can affect your estimate and can make it stale one day after you made it. So bottom line, Rivian investment turned out to be a huge headache for Amazon. And because this Rivian investment has absolutely no bearing on the earnings power of Amazon, this volatility must be taken out of earnings, otherwise your multiples make completely no sense. And again, there is no cash flow behind these gains and losses, so this is having no effect in this regard. Next, we talk about profit before tax, and here you see some of these annoying effects on Amazon's earnings. So for example, because of Rivian, Amazon reported a massive loss in the first quarter of 2022, reported another massive loss in the second quarter of 2022, and then reported another loss-making quarter in the fourth quarter of 2020, all because of Rivian. And that's why I can guarantee you Amazon CFO is not happy about that investment. But let's look at the latest numbers. So in the second quarter, profit before tax was up 37% year-over-year to 20.9 billion. And over the last 12 months, profit before tax was up 53% to just under 83 billion. And to hammer really home this point about Rivian creating a big issue, let's just compare operating income and profit before tax. And you can see that because of Rivian, the underlying earnings generation, which is reflected by operating income, which was relatively steady. I mean, it came down, the green line you need to look at, but it was never loss-making. So there was no problem operationally, no major problem operationally, and then it quite substantially increased in subsequent years. But during this period of Rivian gains and then subsequently just losses, the profit before tax line was completely ruined, as you can see by this enormous volatility, and the we could also use shareholders' net income, which is the number used for EPS. It would show the exact same picture, and during this period you cannot use it for any kind of valuation work because it's just too volatile and jumps all over the place and is not reflective of the underlying business. However, in more recent quarters, not in all cases, but in some quarters, it was quite usable. But the problem is you need that metric on a next 4-quarter basis to work out meaningful multiples, and you always have some volatility. Like here in the first quarter of 2024, there was a massive impact, or meaningful impact, I should say, and then there was a meaningful impact in the first quarter of 2025. So the long story short is Amazon's GAAP numbers are so affected by these one-off items that you have to do adjustments to derive meaningful multiples. So when people talk about PE being used as multiple, I agree if you don't touch it. If you just keep it as it is it's reported. But every analyst knows that who received training in this subject matter. First thing that you learn on Wall Street when you're being taught to do a multiples valuation is that you're being taught the term normalization. You always need to normalize earnings. And normalization means you take off anything that is not assumed to be ongoing. And this, by definition, excludes all one-off items, and by definition would exclude all these one-time equity gains and losses. Because it would be obviously entirely unreasonable to assume on an ongoing basis just gains or losses on an equity investment. Now we move on to shareholders' net income. So this is the number then used to report EPS on a GAAP basis. And here you can see the exact same picture as you just saw in profit before tax. Amazon was forced to report loss-making quarters because of the Rivian volatility. But let's focus on the most recent quarter. So most recent quarter was up 35% year over year to 18.2 billion in shareholders' net income. And then over the last 12 months, shareholders' net income was up 59% to 70.6 billion. And what all these numbers mean, we'll look at when we compare Amazon first to key peers, and then subsequently when we calculate valuation multiples. So before we go to EPS, we first need to look at the number of shares. So in Amazon's case, so Amazon stands out amongst the Magnificent Six in terms of lack of share buyback. So in its entire 31-year history, since it was incepted in 1994, and then when it IPO'd in 1997, Amazon only bought back 7.8 billion in stock. So that already gives you some clue how Amazon is different than the other Magnificent Six, like Microsoft, Apple, Nvidia, Meta, and Alphabet. So you might wonder now, okay, but what do they do with the cash then? They're not paying dividend. They're not doing meaningful share buybacks. So where's the cash going? Do they sit on a huge cash pile? Well, just let's look at the latest balance sheet, and we can see that cash and cash equivalents and marketable securities, and this is what you always want to add together to get to total cash amount, is only 57.7 and 35.4. That's only about 93 billion in cash. I mean, there's still a lot of cash, but given they do hardly any share buybacks, don't pay dividend, where's the cash going? And the other thing you have to pay attention to, you can increase the cash amount not by cash flow generation, but by just raising debt. And Amazon has actually a meaningful amount of debt. So long-term debt is actually 50.7 billion. And then there's about 10% of that, also the current portion of the long-term debt sits in this item. So overall, Amazon has about 56 billion debt. So therefore, the net cash amount, so cash and cash equivalents and marketable securities less debt, is actually not all that much by standards of these huge companies like Nvidia, Microsoft, Alphabet, etc. So where is the cash going? But before we move on to cash, we first need to still discuss EPS. So first we are back to the number of shares, so we can determine that there is moderate ongoing dilution. This is caused by share-based compensation, which is not compensated for by the company buying back its own shares. In contrast, companies like Nvidia and Apple, they have huge ongoing share buyback programs, which also lends share price support on an ongoing basis and offsets any dilution caused by share-based compensation. Now we look at the earnings that Amazon reports. So this is GAAP earnings on a diluted basis. You always want to look at diluted earnings, not basic, if you do any kind of valuation work. And we can see that EPS was up 33% in the second quarter, and over the last 12 months, EPS was up 56%. This looks very impressive, but we have to look at this in terms of implied multiples, which we'll be doing in a moment when we talk about valuation. And then, of course, we need to look at how this compares to other key companies. But here again, you can see the losses that were reported in EPS, again, caused by Rivian. Now we move to a cash flow discussion. So now you see in front of the free cash flow reported by Amazon. I'm also using the definition of free cash flow that is also used in Amazon's disclosure. This definition only slightly deviates from a more widely used definition, but it's a minor point. And you can see that cash flow generation and cash flow accounts for all these accounting things that create non-cash related volatility, like the Rivian gains and write-offs, and is therefore a better view of the underlying business. And you can see that in terms of cash flow, there's enormous volatility in Amazon. And now we get to kind of Amazon's dirty little secret, which apparently not too many people realize. Amazon's free cash flow is actually quite weak. And this might not jump immediately out at you when you look at this chart. You might look at it, oh, look, in the last 9 quarters, there was only one cash flow negative quarter. But this hides the brutal reality that you see in front of you. This is the cumulative total cash flow Amazon produced over its entire existence. And you see the total as of the end of the second quarter of this year, 2025, and the total is, drumroll, 117 billion. Although this number looks large, you have to keep in mind this company is valued at currently 2.5 trillion. And of course, these things are backloaded. Backloaded means the most recent quarter matter most relative to the valuation, because obviously many years ago, the valuation wasn't at this level. But it's still, if you do various types of analysis on the cash flow development on Amazon, you realize there's very, very little cash coming out of this business that can be distributed to shareholders. And all stock market valuation is based on the assumption that at some point, the business returns capital to shareholders. And that is really the key difference between Amazon and all of the other Mag 7. Or I should say Mag 6, because again, Tesla is a different animal. Because unlike the other Mag 6 that have long entered into their best phase, I think Tesla's best phase is still ahead. So I think this is another key observation and one you should keep in mind when we talk about valuation later. But let's now talk specifically what is causing this, let's call it weakness in cash flow. It's not operating cash flow. So this is what you see right now in front of you. This appears to be doing well. So in the second quarter, Amazon generated 32.5 billion operating cash flow. And over the last 12 months, Amazon generated 121 billion in operating cash flow. And the last time operating cash flow was negative, we have to go back all the way to the first quarter of 2022, which was still affected in some ways by supply chain issues that were caused by COVID. So it's not the operating business. The second item we need to look at to calculate free cash flow is capital expenditure. So all the investments in long-term infrastructure, so warehouses, robots, equipment, etc. Amazon takes. And here we see the big problem. So in the second quarter, Amazon spent 31.4 billion on infrastructure, so capital investments. A significant share of that is driven, of course, by the significant investments in AI infrastructure, because Amazon is one of the companies that is trying to become one of the winners in the AI race. The other huge spender is Microsoft, Alphabet, and Meta. And the CEO said on the most recent earnings call on July 31st that the capex spend we see in the second quarter of 31.4 billion is, quote, a reasonably representative of our quarterly capital investment rate for the back half of this year. So in other words, he's saying we expect to spend about this amount in the remaining 2 quarters of 2025. And my base case is this number will not shrink. It's more likely to grow even more. So my recommendation to you is do not expect this business to announce anytime soon a dividend or announce a meaningful share buyback that is larger than a token amount. But before we move on, I wanted to discuss briefly operating cash flow. We looked at earlier and saw there's quite significant operating cash flow generation. And the operating cash flow generation is actually of, I would say, rather high quality. Because first of all, let's look at these buckets. What do these colors mean? So the biggest bucket here in the second quarter is this bright blue one, 18 billion. So this was the net income. That's the starting point. But the net income reflects the deduction for non-cash charges, and very important in Amazon's case is depreciation, amortization. This you have to add back to get to the real cash generation. So this is the second largest bucket, where it is very significant. So 15 billion of depreciation and amortization in Amazon's case in a single quarter. So it's quite massive. And then there's another 7 billion add back from share-based compensation. Payables, although a meaningful positive in the second quarter, we can see this is quite cyclical. And when you do analysis around Amazon's payables, you can see there's nothing dodgy going on. There's no case of Amazon not paying their suppliers, so they actually pay quite quickly. And all the other buckets are quite frankly not that big needle movers. So the items that do drive operating cash flow in Amazon's case are all actually high quality items. So that's a positive. But the big negative is the enormous capital requirement, the capital expenditure need that the business demonstrates. And then the net result is reflected in this, we have to look at this chart, sorry, wrong slide. At this chart as a free cash flow, which is rather lackluster, and you see here in front of you only last 4 years, but the slide we looked at earlier, the cumulative chart for the entire existence of Amazon showed you, this is not a last 4 year phenomenon that was caused by significant investments in AI. No, Amazon has always been highly capital consumptive. And this is exactly what you can observe, for example, in the auto industry. A lot of auto companies that pump out model after model, i.e. using a throw and see what sticks kind of strategy. They have also these very high capital investments and therefore very low or negative free cash flow. And they pump out constantly all these new models to sell them at attractive prices, so the P&L looks good, the profitability looks good, but then because they constantly have to reinvest and have to launch new models that take a lot of capital, their free cash flow looks awful. And in Amazon's case, it's quite similar. So what Amazon did was they constantly tried to optimize all their infrastructure. And just give you one example from the warehouses. Amazon first started out with people running around in aisles in huge warehouses, picking up all the goods that people ordered. And they invested in these warehouse setups with the aisles and everything, cost a huge amount of money. But then very quickly, because profitability was very low and they always tried to optimize, they threw that concept out of the window. And before the cash they invested could be earned back, they already spent new money on completely restructuring these warehouses for bots, driving around and picking certain goods up, or sometimes a blend between humans and bots. And then they moved on to the next evolutionary step in their warehousing system. And they moved from bots not picking up stuff in aisles, but moving like the aisles to the human. And they always did it to stay competitive. But what happened is they never really generated excess returns. So that they were always kind of being chased to defend their high valuation. So what investors fell for a long time is they only looked at these huge numbers, huge revenue numbers, etc., but didn't realize that to generate this huge business and this dominance, this was all kind of built on a weak foundation, because this huge scale and everything was bought by enormous ongoing investment. And that in terms of capital generation made Amazon a rather lackluster business relative to its valuation. So, and I think that's a really important observation when you invest in a stock market, because despite these, I think, significant flaws in the business model, this still made Amazon an enormously well-performing business in terms of share price appreciation. So this carrot that management can hang in front of investors, that at some point in the future, we return capital to you. This can actually work for a long time. And even if you see that the business is highly capital consumptive and there's no cash coming out of it, even if the management can create the aura of, or the illusion of this carrot becoming real some point, that there will be share buybacks, there will be dividends, etc., that alone can drive the valuation. And so that's very important. So the fundamental valuation cannot capture all of this. And that's why you always need to combine fundamental valuation with what I would describe as sentiment analysis. So, and now this is the last slide I'm going to show you in this chapter of this presentation before we move on to comparing Amazon with some key companies. And this is net income margin. So you take the reported net income, you divide it by total revenue. This is not a great metric, but it gives you a high level. The reason why it's not a great metric is it mixes a metric that applies to both debt and equity holders with that only applies to equity holders. So net income only refers to equity holders, and the revenue line arguably mixes debt and equity, but this is more a theoretical discussion and one is not important. So we move on. So just look at the slide. The second quarter margin in 2025 was at 10.8%, and that was actually one of the best margins Amazon ever produced. So, but keep in mind, the cash flow is still not really coming through. So, and I think this improving profitability profile is what actually drove investors like Bill Ackman that I mentioned at the beginning of the presentation perhaps into the stock. And I'm not suggesting he is not seeing the cash flow weakness I was talking about, but he might also see that investors have ignored this cash flow weakness for so long, given by the valuation of Amazon that has sustained a very high level for a long time, that in his view at least, it's a worthwhile investment. So in the next part, we move on to comparing Amazon to key peers. So this chart compares the Magnificent Six, so comprising Nvidia, Microsoft, Apple, Amazon, Alphabet, and Meta, in terms of market capitalization, here shown in trillion on the y-axis, on the vertical, and on the horizontal you see the last 12 months revenue. This is all based on latest available numbers. For Nvidia, because Nvidia is about to report, I used my next quarter forecast to complement the latest last 12 months. So we have a latest view of all of these companies. So Nvidia right now is the most valuable at just under 4.5 trillion in market value. Number 2 is Microsoft at just under 4 trillion in market value, 3.9 trillion. Apple is number 3 at 3.4 trillion in market value. Then Alphabet, aka Google, is number 4 at 2.5 trillion market value. Meta is number 6 at 2 trillion. So Amazon is ahead of Meta at 2.5 trillion market value. But then when you look at the revenue number, Amazon is a significant outlier. Amazon generates significantly more revenue than any of the other companies. So it's only number 5 in terms of valuation, but the clear leader number 1 by a mile in terms of revenue. And when I talk about peers of Amazon, I'm not talking about peers in the sense of a comparable company. There are peers of Amazon would be very different, and because Amazon branched out into so many different businesses, it's very difficult to find a true peer. So I believe there's no good peer that exists. So if you wanted to do a peer analysis, what you should do, you split Amazon into its different businesses, and you search for peers for each of the different business segments, and then you do what's called a sum of the parts analysis. But this is not what we're going to do in this presentation. This is a topic I will be covering in a future presentation. So the key observation here is obviously revenue does not translate into earnings upside for some reason. So this next slide compares the revenue growth and the market value. And here, Nvidia is complete outlier, enormous revenue growth, 72.5% last 12 months. And here, Amazon is number 5. The only Mag 6 that is growing slower revenue than Amazon is Apple. Apple grew revenue only at 6%. So we now already know that Amazon generates a lot more revenue than Apple, is growing revenue faster than Apple, but still is valued at a lower valuation. So why is that? We get more insights from this comparison. Here we look at the market value, but this time at the operating income over the last 12 months. And here you can see when we compare Amazon and Apple, is a huge difference. So over the last 12 months, Amazon generated only 76 billion operating income, and Apple generated 130 billion. So vastly more. And then when you take a simple multiple of market value divided by operating income over the last 12 months, you can see that Apple, based on that metric, only trades at 26.4 times, and Amazon actually is much more expensive at 32.3 times. The least expensive on that metric is actually Alphabet. Alphabet only at 20.4 times, based on also massive operating income of 121 billion on a 2.5 trillion market cap. So just to summarize thus far, Amazon is clear number one in revenue, is the number 5 in revenue growth, but is last even behind Meta, which is has a much lower market cap, is last in terms of operating income. And excluding Nvidia, but Nvidia is like a completely different animal. I talked about this in my Nvidia deep dive. These are some of the best companies on the planet, but Nvidia is just the best of the best at this point right now. And when you look at the multiple, Amazon is actually on this very basic multiple, the most expensive company amongst these magnificent companies. But then, as always, it's not only about the absolute level of earnings delivered, but also about the growth. And this is what this chart now compares. We look at the market value again, but this time how operating income grew over the last 12 months. And here Amazon compares quite favorably, growing 40.1% operating income, and is in fact ahead of all of the other companies, except, of course, again, Nvidia. But you have to keep in mind this comes from a rather low basis, as we looked at in earlier parts of this video. So something else must be going on to explain sort of the divide between Amazon and these other companies. So let's look at net income. So net income is now at the end of the income statement. And let's look at the multiples. So Amazon on that metric, so current market value divided by last 12 months net income, trades at 28.4 times. Nvidia significantly higher, 51.6 times. But of course, Nvidia just grows at ridiculous rates. Apple 34.6 times, so Apple is a lot more expensive on that metric. Microsoft trades at 38 times, also a lot more expensive. Alphabet a lot less expensive at 21.4 times. And Meta slightly less expensive, but broadly similar at 27.6 times. So if we exclude Nvidia, of course, so Amazon's valuation is not too far off from the other guys. With other guys, I mean Meta and Alphabet, but Alphabet looks quite cheap on that metric, so we need to dig a little deeper. But of course, before I do so, I need to mention a huge caveat. Valuation is always forward-looking, and we are looking here at historical metrics, so this is suboptimal. I've chosen historic metrics in this analysis to avoid any discussion about estimation bias and things like that. But I will, in a future video, compare my forward-looking valuation analysis based on my forecast instead of Wall Street to find out where there might be opportunity for investors. But that's for another video. So let's move on to net income growth. Here again, Amazon doesn't look bad, 25% net income growth, but keep in mind the points we discovered in the earlier part of the video series, and it's about cash flow. Compared to these other businesses, there is no share buyback, no dividend. Apple's net income even decreased on an LTM basis, 3%. But because Apple's cash generation is enormous and they have a huge share buyback ongoing, EPS is still doing fine because Apple constantly decreases its share count. So now we bring all these income statement metrics together. So first of all, we keep the valuation YXC, market value, and then but we add the income dimension. So we create basically a PE ratio here, market cap to net income last 12 months. So it would be like a historic PE multiple. And then we put it in relation to the net income growth over the last 12 months. And then we draw a regression line for all the companies excluding Amazon, because we want to study Amazon. So always when you do the regression analysis, you always want to exclude the company you're looking at. So any statistician who is watching this will basically shout at the screen right now because we have only 5 data points with which we draw a regression line, which is less than optimal. Unfortunately, in most valuation situations, you don't have a large number of good comps, and again, this analysis is not about a technical peer group analysis. It's just putting this group of highly popular companies into relative perspective. It's not meant to be a technical valuation discussion. For a technical valuation discussion, first of all, you would need to use forward-looking metrics and forward-looking growth rates. But I still think this analysis has some value because it's part of what's often called triangulation. You look at a company from different valuation angles to see whether these approaches are consistent. And this is what we see actually in this analysis. You can see that relative to these 5 companies, Amazon appears to be on a historic PE multiple, 28.4 times, and earnings growth of 25%, inexpensive, because it's below the regression line. The same would be true for Alphabet, would be even more, it would be even less expensive, and the same is true for Meta. So you might look at this and think, oh, so in terms of valuation, all looks fine. And that's true until we look at this chart, and this chart now puts the cash flow generation into perspective. So we look on the y-axis again at the market value, and then on the horizontal x-axis free cash flow generation last 12 months. And here you can see that in this group of 6 companies, Amazon is a major outlier. The free cash flow was only 18 billion. And this was driven, as we looked at earlier, by this enormous capital investment. So before the AI race, Amazon already spent huge amounts on CapEx, and this number just increased. So the improvement in the business that we saw, all this extra cash that was generated, was all consumed, almost all was consumed by increase in CapEx spend. And that's why we now see this massive divide between these companies. So Apple is the leader in free cash flow generation, but this is also partially a strategic thing in Apple. Apple has something called a hybrid investment strategy, which means Apple, let's call it, encourages key suppliers to make all the big investments in factories, machining, etc., and then just makes fixed purchase commitments with these companies. So all the heavy stuff is not on Apple's balance sheet, but on the balance sheet of suppliers. This creates then a capital light or capital lighter business model. And Apple likes to talk about this in terms of a hybrid model. And that's why if we would plot capital expenditures for these companies right now, you would see that Apple is an extreme outlier, with the exception of NVIDIA, because NVIDIA overall has always been a capital light business up until a few quarters ago, when also NVIDIA started to spend a lot more on its own own factories, etc. But NVIDIA is still a super capital light business compared to the other businesses here on the slide. So in other words, the free cash flow, so Apple, clear leader, but is driven by this hybrid strategy. Then NVIDIA, 69 billion free cash flow. Then Microsoft, 66 billion. Alphabet, also very strong free cash flow of 64 billion. And then Meta, also quite strong free cash flow, 50 billion, even though Meta is also spending at all-time highs on CapEx. But latest quarterly free cash flow came down in Meta's case because this massive AI spend that's going through the roof in Meta's case does leave a mark on free cash flow, even though Meta's underlying business is performing quite well. But again, I'm getting off track here. This is not about Meta. We talk about Amazon in this presentation, and Amazon is a major outlier in this group, as you can see. So the bottom line in this comparison amongst these companies at least, so in terms of earnings growth and implied historic multiple, Amazon looks broadly in line with the other guys, perhaps a little cheaper than someone like NVIDIA or Microsoft, but then there's a huge gap in terms of free cash flow generation. But again, at this point, for decades, investors have been happy to wait for another year or another year to finally see cash coming back to them, and it appears it's unlikely this will change in the future. So until investors are not focusing increasingly on cash generation, this lack of cash flow might not be a problem for Amazon's valuation. And I think this is another key consideration we have to keep in mind when we start talking about valuation. So now we finally arrived at the forecasting section. So this light blue color always shows you the forecast, and this dark blue color the last 4 quarters of actually reported quarters. I decided I will be going quite quickly through the forecast. I encourage you, if you want to pick up more detail, to pause the video and read through the notes on the right hand side of each slide. So I will try to cover the forecast quite quickly, but before we dive into the forecast, here's a quick look at the model. So I built, just for the forecasting, I built around, what is this, about 300 line model, if you're interested in how this sausage is made. Importantly, I forecast each of the segments, online stores, physical stores, etc. separately. This is important because we need to capture different growth profiles and seasonality that we discussed in the earlier part. We of course need to model separately the various operating expense items, because as we established also in the performance review, there are very different trends observable in these numbers. So we need to account for the growth in R&D spend, but also we need to account for the improvement in general administrative expenses. We also have to do adjustments to earnings numbers. We have to forecast the cash flow statement to account for various cash effects, also to derive a reasonable CapEx spend assumption, and to see whether, because if you don't model the cash flow statement, you don't know how much the business can spend on CapEx. And then of course, we need, so here income statement, and then we need income statement adjustments, which you see down here. And for all the valuation work that you will be seeing, we use adjusted earnings later. So with that out of the way, let's go quickly through the forecast. So here's the revenue outlook. So the forecast currently projects slightly faster growth in the next 12 months than in the last 12 months, growth to come in at 11.2%. This is driven by both product sales, which are projected to have a slightly higher growth rate at 7.9% than what was observable last last 4 quarters at 7.5%, and then also a slightly stronger growth in the subsequent years. But the main revenue drivers will be the large service sales revenue stream. They're expected to, in the next 12 months, to grow at the same rate that was achieved in the last 12 months, and then see some slight increase in growth rate. So then in terms of what key business is driving this growth, so here you look at the largest segment by revenue, online stores. I expect growth slightly to be ahead of most recently observable growth rates. Physical stores, I also expect some improvement in the revenue growth rate. Third-party seller services revenue is the number 2 largest segment by revenue. I also expect here positive growth comparable to the growth that was recently delivered. Advertising services, similar. I expect similar growth, so not bullish, not bearish, rather neutral. Then subscription services, I expect this business to continue low double digits as it has delivered. And then AWS, I expect still strong growth, just a tiny bit of weakening. So largely you could say it's an extrapolation of the individual growth rates observable by business. And so it is important. If you just took total revenue and you just applied that growth rate, that would give you a different outcome, because within total revenue there are businesses that have, first of all, different proportions that grow at different rates, and mathematically, if you don't model them separate, you will arrive at a different outcome. So that's why it's important that you split these businesses and model them separately, even though you consistently apply a growth rate as was delivered. Then we move on into the implied gross profit profile, what you see here. So the resulting gross profit is actually growing at a faster rate. So the most recent 12 months growth was 40.5%, and my forecast implies a almost 17% growth rate. A driver is the slightly increasing gross margin, and the gross margin improvement is driven by a greater share of service revenue, which comes at a higher margin. You might be looking at this and think, oh, this is a very modest increase, but when you remember the review we did of this margin, it did only slightly increase over many years. And of course, the higher you get in margin, the harder it gets to improve that margin. There's something called convexity in these margins. But that's a mathematical thing that would take too long to explain. If you're interested in convexity, I recommend read up on duration. It's a related topic. Convexity basically means the lower or higher you get, the rate of change has a disproportionately higher impact. Then we look at the operating profit profile. So my forecast results in a massive increase of 31% year over year. And it's basically a combination of the improving gross profit we just looked at, but then also operating expenses that grow significantly slower than the revenue line or gross profit. And this then translates into disproportionate operating profit growth. And this is perhaps what Bill Ackman saw in his analysis when he decided to significantly increase his stake in Amazon. Then we look at the resulting margin profile, is what you look at right now. So I expect a significant increase in operating margin. So you can certainly not say I'm expecting a bear case here, a bear case. Now we look at operating expenses. I expect operating expenses to accelerate to 12.4% year-over-year growth. But despite the absolute increase in operating expenses, the revenue is still growing faster. This then translates into an operating expense margin. So operating expenses divided by revenue, that still signals improvement, but not very much, and we get to why in a second. Now we look at fulfillment. Fulfillment spend has been quite stable, around 15.5% for quite some time. I expect this, accounting for a little bit of cyclicality, to basically stay constant. I'd like to point out that these margins on fulfillment is only calculated on the relevant revenue, because in the service segment there's no relevant revenue that should be used for fulfillment. It's an important point for modeling. Then we look at R&D. R&D reached in the second quarter 16.2%. I expect significant increase in R&D spend, but on a relative basis, I expect to be R&D to stay within the reasonably observable average range, which is in the high 14% or 15% range. Then sales and marketing, this has also been a ratio that's been quite stable for quite some time, so I also keep it quite stable. Same for general and administrative expenses. I expect on an average basis some improvement. So nothing groundbreaking here really. Then we get to non-operating items. I do not forecast any equity gains or losses in non-operating items. So my non-operating item line comprises exclusively of net interest income and net interest expenses. And in my forecasting implies that the result will be a net amount of approximately, call it 2 billion per quarter. This chart shows you the resulting profit before tax, but we move right on because it's not that interesting. Now it gets more interesting. Now we look at shareholders' net income. This is a metric that will be partially reflected in the EPS. The reason why I say partially is because we need to make some important adjustments that I alluded to in the financial review part of this video. And the resulting delta of the reported shareholders' net income and the adjusted is what you see here. Here you see on a historical basis, just to demonstrate the improvements of the adjustments. The improved earnings line we generated by adjusting for one-off items. So you can see the red line is the adjusted line, the green line is the highly volatile reported line. I will not talk yet again about the high volatility of the reported line, but the point is, once you take out one-off lines, one-off items, Amazon's adjusted earnings was actually quite stable, which is great news because this makes for a good multiple, because analysts Wall Street, they will look through these volatile items, so that the trading in the stock that you see should be more aligned with the earnings metric, and if this statement is true, what you're going to see is a multiple with a little volatility. But this is something we'll be discussing in the valuation section. Here's the number of shares used in the subsequent valuation analysis. I'm projecting ongoing dilution in line with historic dilution, based on my assumption that there will be no share buybacks, reducing the share count. And therefore, because of ongoing share-based compensation, the share count will continue to increase. Amazon simply doesn't have excess cash right now, given the huge AI investment to do any share buybacks. Also, a meaningful share buyback would reduce Amazon's total equity on the balance sheet, and this would also negatively affect Amazon's debt leverage ratio, which is not very high right now, around 15%, which they could increase, and they used to have a higher leverage ratio. But also another factor to consider when you talk about share buyback. So, and that's why I predict, at least for the next couple of quarters, a share buyback is not on the table for Amazon. So now we look actually at the adjusted earnings number. Sorry, it's not the adjusted number, this is the GAAP earnings number. But the one that we're going to use for valuation will be the adjusted earnings number, and this is this number. And when I flip back and forth between these two slides, you can easily see the adjusted number is actually quite a lot higher. And I'd like to point out a key point here. The exact amount of the EPS is actually not the key thing. And then people might jump up and down now in front of the screen and say, shout, this is bullshit. No, just listen. The amount of the EPS, of course, affects the multiple. And a lower EPS makes the multiple high, and a higher EPS makes the multiple lower. But this only matters if you compare a company to other companies to see whether there's one more expensive or less expensive. I approach PE in a completely different way. I use PE to assess just the company in isolation from other companies, just the trading level. So, and whether a company trades at 35 times, 25 times, does not really matter. What matters is what's the implied trading range of this consistent metric, and how does the stock trade relative to that metric. So for example, the insight that, for example, I'm making up numbers, let's say Amazon always trades between 20 and 25 times, and you see, oh, the stock all of a sudden is at 30 times. Okay, this is a sell point. Or the stock is at 15 times. Oh, this is a buy point. Is much more important than, Amazon trades at 20 and this company trades at 15, so this looks cheaper. No, this is like an obsolete and too simplistic way of view of PE. And this is precisely also why, for example, Warren Buffett criticized PE, because people just look at the PE ratio and say, oh, this number is low, this must be cheap, and this number is high, this must be expensive. This is a really stupid way of talking about multiples in general. This is not how it works. So anyways, we are going to use adjusted earnings, and for the adjustment, all we do is we take the reported net income, we take out all the non-operating other income or expense, which mostly comprises in historic periods all the Rivian gains and losses, but also some volatility causing item like FX gains and losses. We make a few other small adjustments, but they're not needle movers in terms of how the amount it affects. We add back all the share-based compensation that is also added back in the cash flow statement, i.e. the non-cash amount, to get to one, a EPS number that is significantly less volatile, and number two, that is actually consistent from a methodology perspective. Because if you use adjusted earnings per share on a diluted basis, you need to add back share-based compensation. Otherwise, you have a mismatch in your ratios, numerator and denominator. Now let's talk about cash flow. This is the free cash flow I'm projecting. And so basically I'm projecting a significant improvement in the free cash flow. This might also be a reason why Bill Ackman invested. He sees the significant increase in operating income that I'm forecasting. He also sees potential for a significant increase in free cash flow. And that's why he might see upside opportunity. But of course, I don't want to put words in his mouth. A little side note, in my prior life, I actually worked once for him as an advisor on a deal, but that goes back almost 10 years by now. So now let's look at how this free cash flow was derived. So first of all, I forecasted all the items of the operating cash flow, the results, the net result of that you see in front of you. So I expect a quite substantial increase in operating cash flow over the next 12 months, 47% increase. And so the net result is that because of this very strong operating cash flow, I think Amazon can afford to maintain its very high capex spend, or at the record level of 31 billion per quarter. The drop-off that you see is just in line with the typical capex cyclicality that you can observe in Amazon's history. But overall, I'm expecting quite strong growth. Last 12 months, Amazon spent 103 billion capex. I expect this to grow over the next 12 months to 127 billion, then 141 billion, 158 billion. So how did I derive this operating cash flow? I did not prepare a slide, so let's take a quick look into the model. So in this section, you see the output of the cash flow statement. So the key items is net income, depreciation, amortization, stock-based compensation, non-operating expenses, income, deferred income tax, inventories, accounts receivables, other assets, accounts payables, accrued expenses and other, and unearned revenue. So what I did is I forecasted all of that. The net income comes directly from the income statement, but then depreciation, amortization, you have to build a separate model for that. you have to project how much investment Amazon has done historically. You have to roll this off. I think I can go through all of this, but I think for most listeners this is not that helpful. So I'm just showing you this to basically make the point that the operating cash flow forecast that you see is not just based on a high-level assumption, some ratio between operating income or whatever, which is a simplifying assumption a lot of analysts often use as a quick and dirty shortcut. But because in Amazon's case, I had to go the long way because there are a lot of specific differences and that make such a shortcut not usable. And that's why I was forced to project each cash flow statement item individually. So let's now go back to free cash flow. So long story short, the cash flow that you're looking at is based on a lot of very detailed modeling. It is not a high-level assumption, and the cash flow outlook looks quite positive, provided Amazon is not massively increasing capex further. Should Amazon feel the heat of perhaps falling behind in AI, for which I have no evidence right now, there's a high chance they would hike capex spend even more, buy even more GPUs from NVIDIA, but also obviously ramp up their Trainium effort, which is their in-house developed chip. So the resulting net income margin profile is what you look at here. So I expect a substantial increase to new all-time highs. Now we're talking about valuation, and the first key input we need is a metric, and in this case we're going to use earnings. So we use adjusted forward earnings. And the adjusted forward earnings we will be using are based on my forecast. And more specifically, they will be based on the adjusted earnings number that I explained earlier. And the resulting next 12 months EPS number from a reporting date is what you see in this chart. So right now, it's August 2025. End of July, Amazon reported. And right now, from the current month's perspective, the next 4 unreported quarter EPS is at $10.06, and this is simply the sum of the next 4 unreported quarters. So the third quarter of this year, the fourth quarter of this year, the first quarter of next year, and the second quarter of next year. And we do this on a rolling basis. So after every quarter, we add 1 quarter and drop 1 quarter and move forward in time. And in this light blue number, you can see actually the adjusted EPS for historical periods, and you can see a rather smooth metric. This is not by fudging numbers. There is one consistent approach applied to all quarters consistently produces this earnings number. So now let's look at how this compares with a consensus. So now I drop this black table here just into this chart, and you can see the average estimate for the third quarter is at $1.54, and I'm forecasting $2.47. So I'm massively above consensus. So what is causing this? The reason is very simple. I'm using an adjusted EPS where I make a lot of add backs. And because Amazon is not reporting an adjusted number, a non-GAAP number, analysts are also forced to report an EPS that is comparable with the, I have to say, useless EPS that Amazon reports. And this makes these consensus multiples completely irrelevant for Amazon. However, of course, analysts in big banks, Goldman Sachs, Morgan Stanley, JP Morgan, and so on, they all will produce adjusted EPS because they, in their valuation work, face the exact same problems I faced, and that the reported GAAP number is just too volatile and is too full with one-off and non-cash items that are not that meaningful. And that's why they will also, for valuation work, produce an adjusted number in their equity research reports. So if you have access to the research reports, what you will see at least 2 different kinds of EPS they will produce. One that is the non-GAAP, and one an adjusted number. They might call it adjusted or a non-GAAP, and in some banks have their own proprietary terms for these EPS estimates. But ultimately, it doesn't matter what you call it. But these EPSs reflect the analyst's best view of the underlying earnings generation. And for valuation work, you always need a normalized and underlying metric. So I just wanted to point out this discrepancy relative to consensus, because this is kind of a special. I mean, there are other companies like Amazon, but among the very large companies, Amazon is an outlier in this regard. But next, as usual, let's convert this quarterly next 12 months outlook into like a more continuous line. So this is exactly what you just looked at. Just now we changed it to a more traditionally shown line chart in this type of analysis. It's called a snake chart typically by investment bankers. But I like to enhance on this, and I smooth out the staircase that you see between the EPSs, and the resulting curve is what you look at now. So if we just flip back and forth between these two slides, it's basically exactly the same. It just smoothed out, and the vertical horizontal line, the vertical line in red shows you where we are right now. So I marked the 15th of August. This is the last closing price as of recording of this video. So this earnings curve is underlying all the multiple analysis we're going to look at in a second. And this earnings curve is based on adjusted earnings. So now we look at the last 5 years of implied multiple based on that metric, and you can see that during the let's call it noisy COVID years, that multiple went through the roof for Amazon. So during the time, Amazon's earnings were there were various one-off effects which are not captured by the adjustment, which actually set in it was still reflected in operating income line. I did not adjust for that, and so earnings were depressed for various things. The problem is you can't adjust for that because you get into too much judgment, too much subjectivity, and as an analyst you always want to avoid that. So that's why we have this crazy outlier curve. But in after the COVID years, global supply chain and other things normalized, we saw the multiple come down quite significantly. Amazon's earnings recovered, and just for people who have not seen these charts from me, so the black line shows the median over not the 5 year but the last 12 months, and the green line shows the range implied by plus minus 1 standard deviation around the mean multiple. So that shows you this demarcates a trading range that is frequently observable, and then the red lines show you 1.5 times around the mean standard deviation, and that so once the stock goes outside the red line, this is like an outlier event on the up or down side, and you can see based on this methodology you could spot good points to sell or buy quite easily. But of course this assumes that your earnings outlook is correct, and number two, that the valuation multiple is not changing too significantly. But let's make this more meaningful by zooming in a bit, and this is what this slide does. So it's the exact same analysis. We just zoomed in into the last 2 years now, and what you can see is that the multiple that we derived from adjusted earnings is actually works quite well, and you can judge this by looking at the implied range. So from the absolute peak to trough, the multiple range is only about 10, let's call it 10x. So from around 16.5 to around 26.5. That is actually not that bad. In a perfect world, the multiple would always be constant, but this type of multiple doesn't exist, not even close, and that is actually not a bad outcome. And you can see that when you look at the green lines, again, the green lines highlight the most frequently occurring implied multiple. You can see over the last 12 months, the multiple stayed at just over 20 times to around 24 times. So was it within less than 4x. That is a very narrow multiple range. This tells us that at least over the last 12 months, and when you look at this chart, you could say probably around last 2 years, that methodology worked quite well. And now let's zoom in a little more. So now we just look at the last 12 months. And you can see that right now, after the stock sold off on the second quarter earnings release, it sold off to below the median multiple, but then quickly recovered and now trades about 3.5% above the median. But still, based on last 12 months trading level plus outlook, stock right now is in a, I would say, normal range. But let's now bring into this analysis the share price. So in this next chart, for people who are not familiar with this type of analysis, so the way this works is you look at the implied multiple, the median, the 1 times and 1.5 times standard deviation, and then you keep these multiples constant and you apply the earnings curve that we looked at earlier to these constant multiples to produce an implied share price range. Because in this methodology, the share price is nothing else than the earnings number times the multiple. And the graphical result of that analysis is what you see in front of you. It looks like a corridor. That's why I usually refer to it as a share price corridor. And right now we can see, based on this methodology, the share price is in kind of the expected range. But let's zoom in a bit more and then also let's talk about the implied share price upside. So at the current share price of $231, this methodology implies that the most likely upside would produce something like 8.5% over the next 12 months, and then 10.8 times on a compounded basis over the next 2 years. So compounded means it's not the total return over 2 years. No, compounded means each year on average you get 10.8% on that investment. That is not bad, but it's also not super exciting, because the S&P, so the broad stock market index, is up almost 10% this year. Of course, it doesn't mean it carries on like that, but if the stock market sells off, so will Amazon, of course. So the question is, from a risk-adjusted return basis, is it worth investing in a single name over the index? That is the bigger question. But then, of course, you can see in Amazon's share price history, there have always been significant outliers to the high side and the low side. So in 2 years or 1 year, we could see the stock trading into the high end of the range or the low end of the range. That is always the big question. So this share price corridor analysis, what it shows you is like an expected range based on the trading levels we can observe currently and on the current earnings outlooks. It's always important to always remind yourself of that very basic principle. So if the market was to sell off in the next 1 or 2 years, and the multiple that Amazon receives on earnings, even if it's assumed the earnings forecast is perfect, it generates exactly that amount of adjusted earnings, the share price would still come in lower than what this right now projects. So now let's talk about the opportunity. So, and when it comes to opportunity, because in positioning your portfolio, you can think about it in terms of going long in a stock, so buying a stock, or of course selling a stock short. Personally, I believe shorting is an important instrument in every investor's portfolio construction. I know amongst a number of retail investors, shorting has like a very bad reputation. It's like betting against companies, manipulating companies. No, this is only a small bad subsection of the, let's call it, shorting segment of the market. Shorting is an important instrument to hedge your portfolio, because we all like, bull market, stocks going up, everybody's happy, but every couple of years there's a significant pullback and you want to protect your downside. And for example, if you identify a stock that may, even if it's a great company, etc., that has gone too far out of its normal trading range and looks overheated, what you can consider is, okay, I take a small position to just in case something happens. I'm being hedged, because when the market sells off, companies that flew high in terms of implied valuation, they often then come down the harder, and therefore they make terrific hedges. And if your analysis is correct that they got a little overheated, that would mean that your downside is also limited. Yes, of course there might be increasing further and it costs you money, but that loss on that short, you should not look at it as like an absolute short and you made a bad call. You should look at it like an insurance premium for your portfolio return. In other words, sometimes you have to be less greedy to actually make more money. It took me a number of years to figure that out. That's why my first couple of years of being an investor, I sucked. But since 2004, I have consistently every year beat the S&P 500, and sometimes by a significant multiple. But anyways, so bottom line in Amazon, this is a stock everyone should have on the radar. I think it's a great company. It has a number of flaws that once you understand them well, and once you observe like implied trading ranges, that, as I explained in this long video, is not totally straightforward. You can't just look at the reported numbers and derive a multiple. It doesn't work like that. if you keep an eye on the stock and look for moments when it gets too high or too low, you can think about taking either a short position or go long on the stock. Apparently, Bill Ackman recently thought it's a good moment to buy the stock. Whether this was a good call, let's revisit in a couple of months or a couple of quarters. But it's definitely a stock I will be keeping an eye on. So that's the end of this video. I hope this was helpful, informative. Please like, subscribe, leave a comment, all this jazz for the algorithm. My videos typically get very, very few views, and it would be very motivating if I get a few more views. Thank you very much for listening. See you in the next one. Bye.